Central banks have been pumping money into the global system. Equity markets have been rising and in some cases scoring new record highs. But with the jitters over the last couple of days with some markets like the Dow and indeed the DAX in Germany down triple digits, the obvious question is this the turning point? Adrian Lowcock joins us now from Architas, where he's investment director. Adrian, good to talk to you. On a global basis, no geographies seem to be immune from this this drop that we've had the last day or so. What are your thoughts as to what's behind it?
So basically, I mean, the trigger has been perhaps a surprise change in expectations of interest rate rises in the US. So generally, markets have been not really pricing in a rate rise in September, but comments from members of the FOMC last week sort of suggested a rate rise could still happen. And that's come as perhaps a little bit of surprise and caught markets out. And it also sort of goes contrary to the economic data that is coming out of the US, which it hasn't been as impressive as it could have been, and has been a bit flat, really. So what it is that sort of change in sort of expectation from central bank action, and it's not quite rubbing right with what markets are seeing in terms of economic data.
Mind you, here in the UK, at one point this morning, all FTSE 100 stocks were down as at, I think, 11 o'clock this morning. Just a few stocks up: AstraZeneca, Shire Pharma, and Reckitt Benckiser. What does this tell us?
So those stocks are generally what you would consider quite defensive. They're sort of healthcare and consumer staples, and those are the sort of things you don't cut spending on if there is an economic downturn. And the dividends are relatively stable in companies that are quite defensive as well, because the earnings are relatively stable. So they're quite natural defensive areas, and they don't tend to sort of move with economic cycles. So if there is a concern that interest rates might rise in the US, but there's also concerns of weaker growth globally, then these are the sort of stocks that tend to hold value better.
If this is the beginnings of a longer downturn, which stocks may be better insulated than others? You're talking there about some of those. Which of those as well are most likely to suffer most if we do see that the markets drop further?
So it's the sort of luxury stocks or the consumer discretionary could suffer. So retailers could suffer because we just don't spend as much in the shops, and there's the fears of a sell-off in markets is effectively a fear that there is a slowdown generally globally in markets. But it's also where it's quite difficult in this environment because valuation alone isn't going to be enough, because a lot of the defensive stocks have been quite expensive, what's been called the bond proxies. But in this environment, they're probably going to remain relatively valued as people continue to sort of look for the defensive assets. But other things like airlines and travel companies, those are sort of things that are quite cyclically sensitive, and they can tend to suffer in a sell-off. Banks could also suffer. Financials could be an area that suffers, particularly as there could be more QE and there could be further interest rate cuts in other parts of the world, and particularly in the UK. Then that could weigh on those markets.
Is that your base case, that the Bank of England could move lower then on interest rates? They've got a meeting, of course, this week.
I don't think they'll do anything this week. The economic data in the UK seems to suggest that things are perhaps not as bad as we expected, and the UK economy is doing okay. And they did enough, and some argued that they did too much in August, and we haven't quite seen the impact of that yet. It's still going to take a few months for the rate cut and the QE announced in August to really hit the UK economy. But they have indicated they could cut rates further, possibly to 0.1%. It all depends sort of what other economic data, and the UK is not alone in this. We need to see what's happening globally as well. So there is still the possibility that there is a further rate cut at some point this year.
Okay, Adrian, thanks so much indeed. That was Adrian Lowcock there from Architas, where he is investment director.